edition of Technical Analysis edition here with me, Roger, and obviously Jason McIntosh, who we met already last week. I can't wait to get into today's topic because I think it's very relevant, not just to trading, but all of life, actually. And I like talking psychology sometimes, so to make me feel a bit smarter. But so let's just get straight into it. Jason, I'm going to pass over to you to do the boring stuff, but the necessary evil, and then we're going to get cracking with some questions. Okay, we've already got some questions on the line here, but let's get going. Jason, just over to you with this stuff. Yeah.
Fantastic. Thank you, Roger, and everyone. Thanks for coming along and joining us for this part two of this special series we're doing on technical analysis and really all things trading. Today's all about the trading mindset, some interesting things to go through, which hopefully give you a few ideas on how you can work your own mind to hopefully manage your portfolio the best you possibly can. And before we kick off, we just got to go through some of the important disclaimers and everything, which we've all got to be aware of these days. It's I'm Jason McIntosh from Motion Trader. I'm not part of Selfwealth, so everything I say is they're all my opinions. And of course, nothing is personal advice. Everything we say today is all general advice only. And you can see on the screen the top part of the disclaimer talks about myself and the license I operate under. I operate under a license held by Sharpening Wealth Management. They've got a license number 422409. And you can pause this, you can read all the other stuff, but yeah, again, just very important to understand everything is general advice, and you've got to do your own due diligence on what's right for you. So with that said, I'll hand back over to Rog for we'll get underway.
Beautiful. All right, I'm excited for today, as I am with any of these series that are going to be coming up. So the first question I'm going to ask you, Jason, obviously you've been in the game for 30 years, right? And it takes a long time to craft what you've already crafted. But what would be, if you had to associate one emotion with trading and investing, what would that be? What would that be?
Yeah, emotions are a really interesting thing when it comes to trading in the markets, and we often get told that emotions are bad. You've got to completely take emotions out of the process, and I think to a large extent that's right. We do want to be able to dial down the emotions, but look, having said that, emotions do have a purpose. Like we're as humans, emotions are part of how we operate. So, for instance, like a little bit of fear isn't necessarily a bad thing, because a little bit of fear might mean that you'll assess the risk of the situation a little bit more than someone who might just have a fearless approach to trading. And a little bit of greed also mightn't be such a bad thing, because it might mean that you'll hold onto a position a little bit longer and maybe get a bit more profit. You don't want too much of either, but a sprinkling of both in how you approach it is not necessarily bad. So people who say emotions are bad, well, I don't think that's quite right, but we do want to keep them under control. I think if you say to me, look, what's the key emotion that I try to operate under? And I think the answer would have to be calmness. So calmness isn't strictly speaking an emotion. I think it's more like an emotional, more of a state of mind. Calmness is probably more of a state of mind than an emotion, but I think it's a really important one to be able to develop and have in place when you're operating in the markets. And I'll tell you, one of the things I've really enjoyed doing over the years is having a day out at the races, out at the horse races. And for all the viewers who have been out to the track, they'll be familiar with the sort of scene I'm just about to illustrate. It's sort of like just think, the horses are running towards the line, they hit the line, they cross, and you look around where you're standing, and there's going to be high fives, there's going to be back slaps, there's going to be toasting of drinks. All this stuff will be going on, and it's different pockets each time. It moves around the area, and so you can tell who's won. You instantly know who's had a win. It's like a state of euphoria. It's a lot of excitement, a lot of joy with that win. then you'll look elsewhere and you'll see other people, be head in the hands, and you instantly know who's lost. And this is so interesting because I think a lot of people approach trading in a similar way as some might take a day at the track, and it's quite an emotional experience. You've got the highs, you've got the lows, and the thing is, the higher your highs, the deeper your lows. So this is why I say calmness is so important. It's about, we're all going to have this sort of like waves of ups and downs in the way we feel. But I think the key is you don't want them amplified in these big swings, like I was just describing from the track. You want to have them. No one's going to be flatline. You want to like try and keep them in check, and that's something I've tried to develop over the years. It's taken quite a while to sort of like mold that calmness. But if you can, I think it really helps, and it's all about being able to make rational and considered decisions when you're under pressure. And the more excitable you are, the harder it is to make those disciplined, rational decisions. So yeah, try and keep it calm.
Yeah. And definitely, and I think most beginners, and I can relate to this as well, right? So, a lot of people compare trading to gambling. Whilst there is those traits, I don't think they're exactly the same. They're certainly not. But people can get really excited when they have a good win. And they jump and they tell their friends about it, and then obviously they can get really down and out, and that's what takes them out of the game completely. Generally, if they have a loss, right? I think it's the ability to have that the same level. Doesn't matter whether you win or lose. And I think I saw something on Twitter the other day. If you're a beginner gambler or a beginner trader, if you get too excited when you win. And I think it's a good point, right? So whether you win or lose, you're still the same. You're going back to the track the next day or back to the trading screens the next day, right? So okay, fantastic. So what about what are some of the key emotions you feel when you're trading yourself? Not just calmness. Is there anything else? Any other key emotions you feel?
Well, look, just generally talking about the emotions that affect people when they trade. So not necessarily me, but just talking generally. Like, you've got those emotions. Like we talked about euphoria. That's one you got to keep in check. Overconfidence is another big one. That's where the ego gets involved with how you operate. I'm going to come back to that a little bit more in a few minutes. Greed often leads to people taking on too much risk. So that's something which has to be kept in check. Then there's discouragement. Like, discouragement is a really interesting one, because you'll see people they might have a losing sequence. Say they have 5, 6, 7 losing trades in a row, and they'll quickly get discouraged, and they'll say, look, whatever I'm doing now is not working. Either I've got the wrong approach, I'm following the wrong advisor, whatever it is doesn't work, I'm going to jump to something else. And they find they're always jumping. They're always jumping because they're quickly discouraged when things don't work. But had they stuck with things or understood a little bit better, they may have found that they were actually on the right sort of pathway. But discouragement takes them out of the game or off to a new approach way too quickly. Vorgo also got stuff like anger. Anger's a big one, losing trade, and people get angry. And like, how do they channel that anger? A lot of them will then go and do something crazy, like they'll double up, or they'll want to make that money back quickly, and they make more mistakes. I think a really interesting set of emotions to contrast are hope and fear. So these are really interesting. So let's just imagine two classes or two categories of trader. We've got the mediocre / unsuccessful trader on one side, and we've got someone who's successful on the other. And just think about how they use how the emotions of hope and fear impact how they approach the market. So let's start with the mediocre trader first. So let's say we've got a stock. We bought a stock, and it's down 20%. So what is the mediocre trader thinking. Now, of course, I'm talking generally. Everything's going to be a bit different from case to case, but just generally speaking, the mediocre trader will tend to jump to hope. Hope will be the emotion of the moment, and they'll hope that a losing trade recovers. They'll hope that it bounces. They'll hope that it gets back to break even, and then they'll sell. And it's all about the hope of getting money back. Now, the successful trader, they're going to approach it somewhat differently. They're going to be more fearful than hopeful. And my greatest fear with a stock is that it goes to zero. So if I've got a stock that's down, say it's down, I'm using 20% as an example. People use different stop losses depending on their strategy. But if I'm down in a stock and say it's down 20%, I'm fearful that 20% could become 40%, could become 60%, could become 100% wipeout. So I'm going to have a strategy to get out. I'm going to fear, the emotion of fear is going to mean I've got a strategy which gets me out before the worst stuff can happen. Now let's flip it. Let's say we've got a profitable trade. Let's say we're up 20%. Now the emotions flip with the position of the trade. So the mediocre trader, they're going to become fearful. So they were hopeful when they had a loss. Now they're in profit, and a lot of them become fearful, and they fear that they're going to get back that 20% profit. They say, look, hey, 20%, that's pretty good. I've got that in, might have only taken me a few months, much better than money in the bank. I don't want to risk giving that back. So I'm going to either take the profit, or I'm going to set a really close stop loss so I don't give very much back. So that's fear. That's fear. That's all driven by fear of giving that money back. Now, someone who's successful is more likely to be hopeful at this point. They say, look, I'm off the mark. This could be a good trade. This could be one of those outliers that go 100%, 200% or more. So I'm not going to be fearful and sell it. I'm hopeful. I'm optimistic that this could keep going. Now, a lot won't. A lot will ultimately just become a modest trade, but some of them do. But you've got to be hopeful. You've got to be optimistic to let those 20% stocks run. You've got to risk giving back a good portion of that if they stall and they do come back, because that's how you get the big outliers. So it's look, it's just interesting to contrast those two, hope and fear. I'll show you a quick example. I'm just going to let me just share my screen with you for a moment, and this is a good example of how it can work with an actual trade. So I'm going to show you a stock. This is a stock from my own portfolio. I've actually got this one in my portfolio currently. It's a company called Duratech, DUR, and a lot of my motion traders. So my motion trader subscription service. This is a signal which went out to them last, I think it was last September about 2022. So 11 months or so ago. And so what we had, I just compressed that data a little bit. It listed, it went into a downtrend. So it listed in 2021, went into a downtrend, nothing to see there, nothing to do there for quite a while. Moving averages crossed in 2022, crossed again in mid 2022. We got a breakout to a 70-day high, which is a key marker for me. And I got a signal and I bought a position. So let's just track this through. I'm just going to move this through time. So this is September 2022 where we are now. So here we go. So the stock's up 30% in the space of it's a couple of months, 6 weeks, couple of months, something like that. So what do? This is this hope and fear situation we're talking about. Do you hope it's going to keep going, or do you fear it's going to come back? And it's an interesting question for the viewers watching now. What do you do if you buy around here and you're up 30% in a couple of months? Are you taking profit, or are you letting it run? And you watch time go on and it starts to come back some more. So look, 30% is now a 15% profit. So this is where the fear comes in. People are fearful this is coming all the way back, but you've got to be able to let these things run, and you've got to be able to risk giving back a modest gain, because this is what can happen. And all the time you're watching this, when do you sell? Or do you sell? Is that enough? Are you fearful enough now to sell, or do you keep hoping? Well, you can probably guess which side I'm on. It's because it's still in my portfolio, and that's where we are today. It's up about 180% or something. But you can only get that by being hopeful. Let the emotion of hope take over, and not let fear take you out at a relatively early stage.
Yeah. Yeah, it's a good point. And I think that at the end of the day, because I know you run obviously a trailing stop loss system, right? So let's say you would go, let's say your trade, I mean, obviously the opposite of that can happen, right? So that is never a guarantee what you just saw on the screen. Many a times the opposite of that happens, right?
Absolutely, yeah.
This is where, emotions can they be controlled by systems. Right. So if you have a system in place that is proven over time, once again, and you're down 20%, you have a system. Do you cut it? Doesn't matter what stock it is, or do you keep it based on? I'm hopeful. I've got a fear of one of the chat things. He says FOMO, fear of missing out. Right. So they know other mates are on it, and they know if I cut this loss and my mates are still on it or whatever it is, that they might be really happy when it goes for them. Right. And then I've cut my loss too early. I've made my stop loss too early. Or do you stick to a system, Jason? That's the point. Do you let the system help guide your emotions? I don't know if that's a valid question.
There's no magic to a stop loss. There's no special point which always works. There are going to be cases where a stock will come back and will hit a stop loss, and you'll get out, and then you'll look at it a month later and it's gone back up. And that can be frustrating. But that's just part of the game. It's not going to be perfect. But this is a thing I'm always telling my members of my service. It's not the ones that rebound that cause the problem. It's the ones that fall and continue falling. They're the ones that ruin people's portfolio. If you take a 20% loss and it rebounds, well, maybe you get another signal to get back in. And if it then goes up 200%, there will be more signals to re-enter the trade. But if 20% goes to 50% to minus 80% to bolt at the stumps and it's delisted, well, it ain't coming back. So they're the ones that cause the damage. That's why you've got to have that disciplined, why I think at least you've got to have that disciplined process for exiting.
Yeah.
And it's stocks like Duratec aren't the norm. Most stocks don't do that. They're what we call the outliers. That's maybe your top 10 or 20% of your portfolio, which will often, trading portfolio, make most of the gains. The majority of stocks are going to make small to moderate losses or moderate profits, and that's going to largely probably net out over time, and then all your gains come from those big ones. You've got to let them run. You've got to let your hopeful side let them run and not get scared every time you're up 20% and close it out. Because once you do that, you cap your gains. You can't get those big triple-digit wins, which are so important for getting a well-performed portfolio over time.
Yeah. Maybe we should compare trading to cricket in Australia here, or baseball in America, obviously, where we're hitting a few sixes versus a whole lot of runs, small runs or fours, right? You're hitting a few big sixes, and they're the ones that really make up your big gains over time, right? So, okay, fair enough. It's good. And what how do you now, when you get into these states, when you get into these fearful or hopeful states, how do you manage them? What do what's the best strategies you can implement to manage these emotions, Jason?
Look, for me, I think now I think for a lot of people who find success in the market over time, I think the key is to systemize what you do. You make it rules based. So something I'll often say to my members is, we don't know, and nobody knows. Nobody knows what the market's going to do next. But if you've got a good process, you've got a good system, you've got a good set of rules, well, you know what you'll do next. So if the market goes up, you'll do this. If the market goes down, you'll do that. So that takes a lot of the emotion out of it, because you know what you're going to do. It takes a lot of the uncertainty away. You got the market uncertainty, but you don't have the uncertainty of, oh, what would I do if this happened? And you're wondering. You know what you do. It's really about you're really trying to make it the whole thing quite clinical, quite procedural, and it's really interesting. So through my service, I get members sending emails, and it turns out that I've got a few pilots as members of the service, and I remember this distinctly because before I got into the markets, when I was back at school, I wanted to be a pilot. So anything to do with aviation always gets my attention. So these guys email in, and they're just independently saying stuff, and they've said, look, I really like the way that your process works, because it's like what we do up in the cockpit. It's procedural. It's all like checklist oriented stuff. And you think about, look, what happens in a plane if an engine shuts down? It's not a case of, well, turn to the guy next to you. What are we doing? What do we do next? And you're flipping buttons and everyone's panicking a bit. It's like, well, no, that's not how it works. That's how a lot of people would trade in the markets. If the market takes a 20% hit, it'll be panic. But that's not what you do when the engine shuts down. You pull out the checklist and you go through the stuff and you go through the procedures. That's how it works. And so this is what I like to do. So this is all about it's just like knowing what you're going to do next. I also do a lot of back testing. So back testing is an interesting thing to do, because you're getting your rules and you're looking at how they're performed over time. I want to see how my rules or my systemized approach has worked over the last 10, 20, 30 years. And not just looking at what it would have done last year, because last year is just a snapshot in time. You want to see a long stretch of data of how your rules work. So you back test. And this also gives you confidence about how it works. And you get to see, you go, well, look, okay, well, I can see this, the market's moving these cycles, and there are parts of the cycles where my process doesn't work as well, but I can see that if I stick with it, this is discouragement. We spoke about discouragement earlier. I can see I've lost money for the last, in drips and drabs over the last 6 months as the market's chopped and gone sideways, not dissimilar to the period we've just had. But if you're able to look at how your process works over a long stretch of time, you'll see that these periods are part of the process. They come, and then markets move again, and the money's made, and you get back testing. You understand all that, and that helps see off discouragement when discouragement comes, because it's all part of the process. And it's really, really interesting. I saw this study. It was a while ago. It was from the Institute of Neurology. You know what I'm trying to say. It's getting stuck. University College.
Neurology.
That's the one.
I'm surprised I could say it, but it got me neurology. Yeah.
It was University College of London, and it was all about uncertainty, because this is a thing which really emotionally trips people up so much in the market. It's uncertainty. It's like, what's going to happen next? And they asked this study group they had. They asked this question. They said, what would be more destabilizing to you? Would it be knowing something bad will happen, or knowing you've got a 50% chance of something bad happening? And it turned out that it was the latter. It was people like, I thought, look, knowing something bad will happen, it's got to be that one. Just instinctively, I thought that's what it would be. And but it wasn't. It was people were more fearful of knowing there's a 50% chance of something bad happening. I guess it's because, like, we know something's bad happening, we're mentally prepped for it. But it's that uncertainty. Will I wake up tomorrow and there's bad news? And people hate that. People hate uncertainty. And the stock market is uncertainty with a capital U. It's just how it is. So we've got to find ways of dealing with this uncertainty. Otherwise, we can't play the game. We can't live with this constant uncertainty. Could the market fall 50% tomorrow? Well, it probably won't, but it could. It could. And so if you can't live with that, you can't trade in the market. And this is why, again, while we systemize things, so we know what we're going to do, no matter what the market's going to do. It doesn't tell us what the market's going to do, but it just tells us what we're going to do. And it's, it helps us just unhinge ourselves from the inherent uncertainty of the environment that we operate in.
Yeah, I think it's really important. A couple of things there you bring up once again. It might be some people from the other Selfwealth Live we do here, which do a lot of fundamental analysis versus technical analysis. But either way, having an exit strategy, a systematic exit strategy for a lot of stocks, I think is really important. I think that's what gets missed sometimes when people do just the company report analysis and things like that. So they don't know when to exit. But having a system that's been back tested for the last 15 to 20 years is probably, or even less, I guess, but not just 1 year, but at least a few 5 years, right? At least you've got some confidence in saying, hey, I know this has been tested over all sorts of market conditions already. I know this system I'm using has worked in the past, and that gives me a lot of confidence to meet the rules and keep going with the rules that I need to enter and exit trades. I think that to me is probably one of the most important things that you mentioned there. Plus the plane analogy, once again, I think that's a very important one. A lot of people know how to take the plane off the ground, but then what happens when the plane's starting to crash, right? Well, then it's who knows when we're going to exit or get out, right? So there's some important points there, Jason, you bring up. So I like that. Very good. What about, have you tried anything that's in the past that hasn't worked? Have you tried anything that hasn't worked, or any emotions that don't work for you, or what's some of the emotions you don't work?
Yeah. Look, look, I think we all try things that don't work particularly when we're starting out. And I remember early in my career, well, probably even before my career really kicked off, when I got involved with trading with a big investment bank. Like, probably this is back when I'm at school and university. The sort of things I'd be doing, and it was like the things that didn't work were all emotionally based when I look back at them. And revenge trading was a trap I've fallen into numerous times, where you lose money in a stock and you go, well, that stock cost me. That stock owes me. I've got to make my money back in that particular stock. It's like, the thing to remember is the market's not your personal nemesis. The market's not out to get you. The market doesn't care whether you've made money, lost money, doesn't care. So we shouldn't like get caught up in this notion that a particular stock owes us money. Market doesn't owe us anything. Our job's to try and look for setups that could make us money, not to go into battle with particular stocks or markets or whatever description it is. And if you do that, if you dwell on setbacks from individual stocks, you end up creating these mental monsters that really do then you fall into these emotional traps, and it becomes emotionally destabilizing, and also it just clouds your vision and stops you from making good decisions. And I think another one, and I see this one. I see this quite a bit when I'm reading, news services where they're just talking about, people come and talk about their ideas, fund managers and whatnot. And one of the popular headlines will be something like, 5 high conviction ideas for 2023. And the mistake here, well, the mistake for me in the past, and I think the mistake that is continually made, is high conviction. It's like when you think, and like I've had these stocks in the past where I've said, look, this stock is, I remember this back from when I was in high school, my year 12 was involved in a stock, and it was like they were going to find gold. It was an explorer. I'm certain they're going to find gold. They're in the right area. They're going to do it. High conviction. And the stock doubled. I didn't take profit, and then it ended up being delisted in the end. So high conviction. It's the problem with high conviction is, as soon as you say you're high conviction, your ego's getting involved. And ego in the stock market, ego in any market, just doesn't mix very well, because it's like you're then too inclined to say, look, the market's wrong. The market doesn't get this. I understand what's going on. The market doesn't get it. And well, the problem you have here is the market doesn't care what you think you get, but the market's doing what it's doing. And if the market wants to take this in the completely opposite direction, despite your high conviction, you're going to wear the loss. So I want to show you. I'll show you. This is a real life example. It's a really interesting one. I'm going to share my screen again, and so this goes back to it was the late 19. It was actually around 2000, probably 1999 to 2000. And where are we? It's I've just got to go back. I had this all nicely set up, but the internet drops in and out and it's reset the chart. So let me just get this together for you. So this is a stock. Let me just, where are we? Here we are. Okay, so this is a stock called Ansell now. It used to be called Pacific Dunlop, and I remember there was a fund manager of the time. It was during 2000, and Pacific Dunlop had been through this huge decline. A lot of shareholder value had been lost. But when this manager and various others, there were a few doing this, so they were breaking down the numbers, and they were saying, look, the breakup value of this company is worth more than the current market capitalization. So this has to be a strong, out of favor value buy. We're buying something for 50 cents in the dollar or something along those lines. So let's just get some more room on this chart. So this is where it was at the time, and anyone, like, if you've got a keen chart eye, you'll probably recognise some of the patterns or the pattern I'm about to draw in. But I remember like looking at this and going, look, this stock's in a downtrend. It's still below the moving averages. Yes, it's going sideways, but I don't know. Maybe it's a base, but there's no sign that this is a great buy at the moment. And if you've got a bit of a chart eye, you probably spotted there's a triangle trading range here. We'll talk more about triangles another day. So this was really interesting. So all through this period here, this fund manager was coming up with this high conviction commentary that this was below breakout value. It had to go up. He had a big portion of the fund's money in this stock. And I'm watching, and then it starts to break down. And I can't remember how the commentary went at this point, but I'm pretty sure they remained in, well, the fund remained in the trade, and the stock continued to fall away. And this is a high conviction idea, and it becomes a complete disaster. It's down 50%. Fell another 50%. I think ultimately the fund manager was moved on elsewhere, and someone else came in and they cleaned the stock out. They cleaned it out somewhere down around these lows. And what's also interesting, if you've got a bit of a chart eye, you might see a chart pattern here. We're going to talk about this sort of pattern in a few weeks' time, but let me just draw it in now, because this is all about emotion as well, how emotion can be and sentiment can be useful in trying to work out where the market might be going. So this is a bullish wedge. And as the market falls into this into the apex of the wedge, it loses momentum and starts to break higher. Now, if you know your history, this is 2001. This is September, so we know there was a big event then. It was, of course, September 11. Now, for those watching who are a bit younger, aren't really up on what the market did then. The market fell heavily when the terrorist attacks happened. Look at what the old Pacific Dunlop did. It barely fell. So this was a sign that everyone who wanted to sell had already sold. And I just started up a subscription-based service 12 months earlier, and this was a stock we were watching. We got the breakout, and that became a buy recommendation. It was like that was the time to buy. Not here when it was trading sideways in a range, having high conviction. It was just being humble and going, look, the market will do what it will do. Wait for the breakout. The breakout didn't come for another year, but when it did, it led to some good gains. So it's about knowing when to buy, have a strong view on something, but hold that strong view loosely, and don't hesitate to say, look, it's not working, I'm out, I'm wrong. It's okay. It's okay to say I'm wrong. We don't need to be right on everything we do in the market. I'm wrong heaps of times, but the thing is, when I'm wrong, I tend not to lose too much. When I'm right, I can make quite a bit. So being wrong is not a problem. A problem is having high conviction and not being prepared to say I'm wrong. That's what can lead to a lot of trouble.
Yeah, good points. Ego, and once again, just this goes back to being level-headed, right? So I think it just meant admitting when the trade's gone the incorrect way and getting out, and then just once again letting the winner run, and just still being level-headed, right? Knowing that it could hopefully not another big event might happen and just make it dive, right? So, but knowing that you're ready to get out whenever you have to, right? And just being level-headed. Fantastic. All right. I got one talking about like habits and being disciplined. Is there anything that you do that helps being disciplined with these things, or any habits that you might have that are important to you to stay disciplined in trading, Jason?
Yeah, look, it just comes back to that systemizing the process, and so every trade I take and every trade I exit, I understand why I'm doing it, and that and when you understand why you're doing something, then it becomes repeatable. And this is a really important concept, I think, to take on board, in that if you're going to have longevity as a trader or an investor, you've got to have what you do has got to be repeatable. You've got to be able to repeat an earlier win. So if you make 100% in a stock, how do you do that again? And I think a problem a lot of people find is they say they do have a big win. Say someone has, they say they're up 50% in a stock, and you go, hey, you did well in that stock. How did you do it? And they go, well, yeah, I read a report, or I like lithium, or someone told me something, or it's nothing they can nail down. And you say, well, why'd you sell? And say, well, I was up. Look, 50% was a round number. It seemed like a good gain, so I sold. Nothing there is really repeatable. It's all sort of ad hoc. It's all sort of like just sort of like ground together. You want to be able to say, well, I bought because the stock broke above the moving averages. It hit a new high, and I let it run, and I sold because it fell back and hit my trailing stop. My trailing stop was calculated by this, and that.
Yeah.
That's repeatable. You can do that over and over again. It won't give you the same outcome over and over again. You'll have losses, you'll have wins, but it's repeatable. And you keep your losses relatively small, and you let your big ones run and run and run.
Yeah.
That's the magic. That's the magic to making the whole thing work. So that's what I'm doing. I'm systemizing, and that's helping me keep the emotions in check. I get emotions like everyone. Drawdowns are a bugger. No one enjoys a drawdown. It's a drawdown, of course, is when you get a high in your portfolio, and then it comes back during a market pullback, a consolidation, or a correction. During the period we've had over the last 2 years, they're not fun. But if you understand your process and you systemize, you can see off that discouragement, and you follow that same repeatable process, which is what a lot of people they don't do. It's too it's too random in how they select and how they exit.
Yeah, and this is obviously going to lead into the topic of next week, which is processes and systems. So it's going to flow in perfectly, talking about habits and how that goes into your processes and systems. But maybe what we'll do now is I'll have a look and see if there's any sort of questions for you, if that's okay, Jason. Now, one of the things we talk about is fear of missing out. Have you got any sort of, do you have any sort of insight around fear of missing out, like from an example point of view? Or how do you sort of deal with a stock that once again, I know you say you use systems, right? But for me, I know there's a lot of times where I think something, or I should say, I think something's going to break out, right? Actually, it's hit the trigger, but it's hit the signal, but I don't want to take it right now because something's going against me. But then I've got that fear of missing out, and I want to do it, but I don't. Do you know what I'm getting at here? Like, how do you sort of handle that? Not putting on a trade.
Yeah, look, the clinical way to handle everything is just follow the signals. You just follow the signal, buy and you sell. But unfortunately, we've all got these undercurrents of emotion, and what is what we should do is not always what we do. And look, I fall into this trap myself. I've been doing this for a long time. Been doing this since I've been in markets since employed in markets since I left uni in 1991, and so I've been doing it for a long time. But I still make mistakes, and sometimes I'll get a signal, and for whatever reason, I don't take it. Maybe I'm distracted that day and I miss it, and I come in the next day meaning to buy, and it's up 10% or it's up 20%. It's like, this is now what do I do? And there's nothing more frustrating than seeing a stock that you should have bought continue to rise. And it's happened to me on a few occasions. There's a stock currently which I sent out to my motion trader members, and I didn't buy it myself because I wait until they buy, and I buy a day or so later. But just gave this stock a bit of a chance to get away from. I didn't buy it, and it's currently up about 100%. So I've missed it. It's a source of frustration every day because I go through the stocks in the portfolio and I see what I should have and I don't have it. Normally, when that happens, I'll say, well, look, I've at least got to get something. I'll buy a half position or a quarter position. I'll get something on board. So if it does keep running, I've got something on board. I'd rather have something in play than nothing in play. And I think that's probably for me, that's probably the best way to deal with that. What do you do when something starts to move and you're not on board? Just wishing that it falls and crashes isn't really much of a strategy. I think the better play is to, if provided the risk reward parameters are still reasonable, to probably get something on board.
Yeah, and oftentimes, obviously, if something's broken out and you didn't get in there, that's the point of technical analysis, right? If you're not looking at charts, then generally you know about technical analysis. What will happen is it'll go up and then it'll retrace. There's potentially what's another setup about to form, right? So there's another entry point where you may want to get in half a position or something to what you would have originally, right? So you've got some exposure.
Right? There's always another entry point.
Yeah, there's always another opportunity.
There's almost always another entry point. And if you do miss a stock, the thing to remember is there's 2,000 odd stocks on the ASX. There's lots of opportunities. If you miss one, it's annoying and it's frustrating, and you should try not to miss a signal that you're meant to follow. But rather than getting too emotionally worked up about it, you go, well, okay, look, I made a mistake or I missed it. I'll get the next opportunity, and there will be another opportunity. There's more than one stock that does well each year, and it's about looking for the setups and consistently applying your process. Remember, you want to get a repeatable process. It's just repeat, and you're looking for stocks which have a certain setup depending on what it is that you look for, and you just keep playing them, and over time you're going to get a number of stocks which probably do really well. And if you miss a few, well, it's
Again,
you can't get everything, and it's I accepted long ago that I didn't have the capital or the time to play every opportunity, so just had to accept some are going to run without you, and it doesn't matter what your mates are doing. Just follow your own thing. And this is what catches people out as well. They're too focused on what other people are saying. Someone's saying, "Oh, look, I've doubled my money in lithium," but a lot of what people tell you is just made up, and they also don't tell you the stuff which goes really bad. So comparing yourself to others, and this is something we all should know from all sorts of situations, not just the stock market. It's fraught with such danger because you can see the facade, but you can't see behind. So a lot of mischief goes on, and people talking about their great victories, because you're only hearing part of the story.
All right. Well, I've got a question here around MAD and the ticker MAD. Maybe let's have a look. It says, "Hi Jason, could you highlight MAD to expand on this?" So I'm not sure at what point, maybe fear of missing out we were talking about at that time. Maybe bring that up and let's just have a look. Give us a bit of your overview technically on MAD, M-A-D.
Yeah. So what is it? Just general comment on MAD?
Let's just do a general comment at the moment, because I don't think there just says, obviously when he asked the question we were talking about a topic, but
and this is a good thing to do. I'm happy to have a look at some stocks as we go through and we talk about technical analysis and analyze some individual stocks. It's this has been one which has been in a great uptrend. It is a motion trader stock. It first appeared in the motion trader signals when the moving averages crossed. It was probably around here. It was back in actually I think it was further back. I think it first appeared in 2020 when the moving averages crossed around October 2020. Moving averages crossed. We had a breakout, and so that was a signal to start looking at Matter Group, because we had a stock which was trading above rising moving averages. It did have a pullback, but the pullback is quite modest. And I operate on the notion of having a wide trailing stop. I want to give stocks plenty of room to move. So if I'm just like say this was the buy trigger here, it would have been completely reasonable to have a stop loss somewhere down around where I've got this red block. Just out of interest, how far is that? That's around a 20% stop loss. So that's well within the realms of being able to see off a consolidation like that. And this has been such a good trend. It actually hasn't exited. Even this year with a wide trailing stop, you can see off some of these consolidations. Where it is now, well, look, it's at the point now where it has had such a big run. It's up from the motion trader signal, it's up about 500%. It's a case of, look, it's a case of letting the profit run. Like people say, well, look, surely this is going to top. Maybe it's topping out now. Maybe this is an exhaustion gap where it gaps up, and that's a sign of the ultimate run out of steam. Maybe there's a little bit of exponential rally into that. Maybe a top is near. But look, you could have said that at various other points along the way, and the way to have made a lot of money in Matter Group has been to stay with the trend and give it room to move. So I won't get the ultimate high in Matter Group. My stop loss for Matter would, I don't know where the motion trader stop is offhand, but it's probably somewhere back down around maybe $5 sort of mark. So it's going to give it plenty of room to move. Near term, we are stretched above the moving averages, and we do have this gap. So maybe the best case scenario would be some sort of consolidation. It can't really keep going up like it's going up, or it becomes vertical, and vertical is not sustainable. So I think best case would be consolidation, and then maybe a continued rise. But it's probably not an asymmetric entry point, but if I was holding it, I'd certainly continue holding it at current levels.
Yeah. What about PLS? Has that found support? PLS, Pilbara, is that Pilbara?
PLS. Yeah, let me just go back to the screen share. So PLS, it's well. Yeah, it's well, it's below these highs from October 2022. So there's going to be, you'd expect there'd be some sort of resistance coming in. Maybe you can even use those current tops. And
can we say that's found resistance more than support?
There's probably some resistance coming up. Well, there's certainly going to be resistance at a previous high. But it's a case of resistance can and is broken. Whether it's broken on this occasion, we don't know. But from a positive standpoint, we've got rising moving averages. So I'm looking at a 50 and a 100-day moving average. Prices above the moving averages. So there's the potential for this to have another test of this resistance and break above it. If I was long this stock, I would I'd stay long at this point whilst it's above the moving averages. I get concerned once a stock starts to turn below the moving averages. Then there's always a risk of how big could a correction get. But at this point, the upward trend. At this point, the upward trend is very much in place, but there still could be consolidation within this range that it's been in over the last year. We could get a market which pulls back into the range and then starts to break higher later on. But at the moment, I'd give the upside the benefit of the doubt.
Yeah. Okay. I think we're going to wrap up here. Not really more technical. There's a couple of general questions here, which we'll just quickly go over. Got what is half a position? I mean, it's whatever. I'll let you explain what when I said half a position, Jason. Maybe you can explain that.
Well, it's going to be different for everyone. Yeah. So say your regulator. Say you I use an equal weighted portfolio. But everyone will be a little bit different. Just say, for example, you're using your regular investment is $2,000 per stock. Half position is simply $1,000.
Yeah.
Some people do things differently. They might do, look, I do 5,000 in large cap, and 2,500 in mid cap, and 1,000 in speculative stocks. So your half position is going to be different depending on how you operate. But it's just saying, look, rather than a full bite, I'm going to have a nibble. So I've got something in play.
Yeah. And finally, we didn't get touch on this topic, but how do we avoid burnout? Obviously trading too much or trading too little even, or just sometimes you're not getting the results you want. So you get burnt out and you're over it. Right? How do we avoid this?
I think the biggest advantage for the retail trader is they can decide not to play. And so when I was back on the trading floor, look, you can decide not to play for a couple of days, but you can't sit it out for a couple of months, or they'll say, well, look, we'll give you a seat to someone who does want to play. So there's always the pressure to make something happen when maybe there's nothing really to make happen. But as a retail trader, if we go, look, conditions don't suit, you might say, look, the ASX 200 is below its 50-day moving average. I'm just going to sit on the sidelines whilst that remains the case. Maybe you're out for 6 months. That's okay. So this constant, like, you don't have, it shouldn't be a case if you constantly feel you're going into battle with the market. If it's the great Jesse Livermore, so one of the traders from the early 20th century. He'd made several fortunes and lost several fortunes. Famous story, really interesting guy to read about, and does a lot of the stuff that we talk about, like trend trading and breakouts and stuff. He'd say, look, when the markets just became choppy and he didn't see the trends, he'd just go off in his yacht go sailing and fishing for a month or whatever it was, then come back when the market started to clear up. It's nothing wrong with having some time out and not playing, do other things. You don't need to be taking positions every day, every week, when conditions may not suit what you're doing.
Yeah. Yep, I think that's good advice. Obviously we could go on forever when it comes to psychology, trading, sharpening your mindset, but I think we've given the audience quite a good lot of tips and advice, right? So lastly, sorry, I want to just say none of the things none of the stocks that we put up are advice to buy them or none of that, right? Just because we own them doesn't mean that's our opinion. Obviously, you have to go out and do your own due diligence. All right, it's all general advice just to make sure everyone knows that. Okay, but look, at the end of the day, I love what we're doing here, Jason. There's sometimes we've got some questions here that probably a little bit off this topic, but we're going to get to them, right? We've got a bit of method to our madness how we're doing this. But it's important that we visit this topic first before we start getting into the next ones, right? So the next week, we're going to talk about processes and systems and getting a lot more involved. But if you don't have your psychology right, sort of that doesn't really work anyway, right? But anyway, Jason, anything else from you, mate? Really appreciate your time, as always.
Yeah. No, look, it's been fun, Roger. I just saw a question: do I short stocks? And I just quickly answer that since I just saw it. Look, no. I think every system I've ever seen, they make most of their money by being long, whether it be stocks or metals or whatever it may be, indices. It's long. It's just the mathematics of it. The most a stock can fall is 100%. The most it can go up is infinite. So you've got that natural built-in growth potential with going long, and short as well. When something's falling, it tends to zig and zag and be more volatile, whereas something which is rising tends to rise in a more orderly fashion. So it's more conducive to being able to take a position, having trailing stop which will continue up and keep you in it, rather than getting knocked out on some of these. The bear market rallies can be quite violent. They can be like, you can get a 50% bear market rally off a low, and then the stock collapses again, and all the time staying in a downtrend. So I find I like to keep things simple, and and I'm going for those stocks which are going to get me triple-digit gains. I'm not getting them dead on the short side, so that's where I focus. But Roger, that's been great. Been a lot of fun coming in and having another talk about the markets, and look forward to doing it again next week.
Definitely. All right, guys. And don't forget to like and subscribe if you haven't. I'm just getting reminders here from marketing as usual. Like and subscribe. And also, if you're not part of the platform yet, then please try it out. Jump on Selfwealth or jump on any of the links that you see and try out the platform. Simple to use, easy, and the brokerage is at a great price, obviously. So have a great day, everyone, and bye and see you next week. Take care. Bye.